Super, thank you very much. Good. Okay, so welcome again to our third Monday evening. So we've got 7 till 8 this evening. If it's your first time of joining us, welcome. If it's your third time, also welcome. If you're watching on YouTube and you'd like to tune in live for the live lectures, you can register on the First Intuition website. So you can go ahead and register yourself, and you don't need to message me. Everything else will be able to come through. I will, Eva, absolutely. Can you ask me the question at the end? Because I did just ask if anyone had any questions. So we will make sure we'll do any questions, but just keep that question and just pop it at the end as well, and I'll be able to go through them. I want to make sure that we do spend the full hour on our tax. So keep any questions that aren't related to tax till the end now, and we'll be able to go through those. And I'm happy to go through as many questions as you do have, absolutely. So 7 till 8, we've got our session this evening. So I'm Rebecca Empson. I am a Chelmsford First Intuition tutor. So I'm going to be running this session with you this evening. The format of the session is we always start off with a quick little fun quiz based on whatever topics we are covering this evening. And then we go through 2 task bank questions that if you have registered today and I haven't sent you out the pre-work, I will just quickly send that to you in the group chat before we start those questions. I'll wait till we're just about to start, just in case somebody else logs in while we are doing our quiz. So let's just have a look at what our topics are for this evening. So all of these files that I use are saved on our Dropbox link. So at the end of the session, you will be sent an email with a link to all past recordings and the recording from this evening, a link to all past pre-work and the pre-work for this evening. It's also got all of the past information on there, and it's got a copy of this as well, so you can see the previous questions that we have been through. So this evening we are covering tax planning, which is going to be task 8 in your exam, and we are having a look at capital gains tax, which is task 9 in your exam. So these are the 2 that we're going to have a look at this evening in our session. So if you haven't received them in advance, just before we start, I will just quickly send them out to you on the chat box so you can follow through with them. But this is all being recorded so you can do it in your own time. Good. Let's start off with a Menti quiz then. So if you haven't done this before, if you just go to the website www.menti.com and use the code 19104, I should see people start to fly in on our quiz. If you haven't got a phone or another device to do this, don't worry. You can still play along on the screen, so you'll still be able to follow what we're doing. If you are going to write it in the chat box, if I could just ask you to pop it in the last 2 to 3 seconds, just so that it gives everybody else a fair opportunity to obviously answer their parts of the questions as we go through. So I'll just give it another minute. Just for any first timers, how this works, you get points for the correct answer and you get more points for how quick you are. Now, obviously, the most important thing is that you know the answer to the question, so don't rush it. Make sure you do read it carefully. It's just a little bit of fun that we just like to start off with. And our topics this evening are looking at tax planning and capital gains tax. That's what all of your questions are going to be around. You'll be able to identify whether it's a strong topic for you or one that you feel that you need a little bit of work on. Okay, looks like our participants have started to slow down. A couple more just joining. I'll just give another 30 seconds and then we will get started. Okay, if you do want to join the quiz late, those details do stay at the top of the screen as we do go through. It doesn't matter, remember guys, it's just a bit of fun. You can play along at home. The most important thing is that you do obviously learn something from this quiz. So if there's something you didn't know before, you know it before you get to the end. Good. So starting our quiz then. First questions, these will come up on your phone. Todd and Helen are married. If Helen is an additional rate taxpayer and Todd pays the basic rate, should they split any dividend income equally? So it's a 50-50, yes or no. And we're talking about tax planning tonight. So do you think that it would be a good idea for them to split it equally, or should they think about it a little bit more and think about how they split? 4 seconds, 50-50, you might as well give it a guess if you're not sure. No, perfect, absolutely. Can anyone tell me on the chat box why they shouldn't equally split it? So why have you said no? So that's brilliant, 19 people, well done, absolutely spot on. But why have you said that? Why have you said that they shouldn't equally split it? Everyone has the same dividend allowance, absolutely, but that would mean that they would equally split it, surely. If you have the same amount, then you should split it equally and everyone gets the same dividend allowance. Absolutely, Nadine, you're absolutely right. Perfect. Now, here we go. Helen is it's the other way around. Helen is an additional rate taxpayer, which means that she pays a higher rate of tax. So if you look back at your tax tables, if they're splitting dividend income equally, anyone who is a basic rate taxpayer will pay 7.5% on their dividends. Anyone who's an additional rate taxpayer will pay 38.1% on those dividends. So they shouldn't split it equally. They should make sure they split it in a way they both use that £2,000 allowance. You want to make sure that you do both use that, but actually the majority of it should stay with Todd because he is going to be paying a lower rate of tax. So as a couple, they will pay less tax. Is there any questions on that? Is there any questions around that? Does that make sense? Good. Let me know if there are, but hopefully that makes sense. That's the kind of things you're going to be asked about when you are talking about your tax planning. Should things be split equally? You're all right. You all got the £2,000 dividend allowance, but that would mean that you should split it. What are the reasons why you shouldn't? Perfect. Okay, let's have a look at our leaderboard. 19 people got it right. So remember, you get extra points for being the quickest. Let's see how we all got on. Scott's the fastest and he got the right answer. So at the moment, he's going to stay at the top of our leaderboard. Let's see how he does over the next 4 questions that we've got coming up. Good. Question number 2 then. Another tax planning question. Do married couples only receive one personal allowance and one annual exempt amount between them? Again, 50-50. So you've got a 50% chance of getting this right. Do they have to share a personal allowance and an annual exempt amount, or do they get their own? If you're unsure, you've got 13 seconds to have a 50% chance, yes or no. Let's see how you get on. So last 6 seconds. Take a guess now if you're not sure. Brilliant. 21 people out of 24 getting that right. You're absolutely right. They don't. Every single individual person, whether they are married or not, is taxed as an individual. So that means they all receive a personal allowance to themselves and they receive an annual exempt amount of their own. Absolutely. So we just said a moment ago about that £2,000 dividend allowance. They should both make sure they use that up. Exactly the same here. If you are a married couple, you should try and make sure you both use up your personal allowance, because obviously that's income that you can actually receive tax-free, and you both receive an annual exempt amount. So if you are selling some assets for capital gains tax, you want to try and make sure that both of you use up that amount. Good, perfect. Well done, guys. Let's see what that's done to our leaderboard then. Let's see if Scott stayed at the top. He's the fastest, and it looks like he got the right answer. So after question number 2, Scott's still there. Let's see how he does on the next 3 questions. Good. Question number 3. This is on your tax tables, but what is the annual exempt amount that is relevant for your exam for capital gains tax? These are all old rates of something. So I have tried to make it a little bit more difficult. If you're not sure, you've got 17 seconds to look at your tax tables. But is it 11,300, 11,700, 12,000, 12,300, or 12,500? You've got 5 seconds to guess if you're not sure. Perfect. Well done to those 22 people that got that right. Perfect. Absolutely spot on. What's 12,500? Someone tell me in the chat box. It is relevant for your exam. Well done, guys. Well done, Lucy. Well done, Natasha. Well done, Nadine. 12,500 is your personal allowance for income tax. So it is relevant for your exam, but it's not your annual exempt amount that is for capital gains tax. So you are absolutely right that it is relevant in the exam, but just not for capital gains tax. So just try and make sure you don't get those two mixed up, because it could be an easy mark that you lose in your exam. 11,700 is just an old rate of of annual exempt amount. So I just threw a couple of old ones in there, just in case anybody have done this syllabus already, but they hadn't yet sat the exam, just to try and make it really, really clear to you all that it is 12,000 for your exam. But it is on your tax tables. And in a minute, when we switch over to my other screen, we will have a look at that. And you don't have to actually remember it for the exam, because it is available to you in the exam. Good. Let's have a look at what that did to our leaderboard then. Scott remains the fastest. Well done. You're flying this evening, Scott. Well done. Staying at the top. 2 questions to go. Can you hold on to it? So, which of the following description defines a chattel? Defines being the word. So, a tangible movable property, an asset with a life of more than 50 years, an asset with a life of less than 50 years, something that depreciates, or a painting. You've got 12 seconds. Can you remember the official definition of a chattel? Perfect. Last second. Brilliant. Well done to those 13 people. Absolutely spot on. Now, these 3 here, so an asset with a life of more than 50 years, less than 50 years, and a painting, they are all examples of chattels. So it was a little bit of a nasty question that I gave you, because those 3 are examples of chattels, but the actual definition of a chattel is tangible movable property. So it's something that I can pick up and I can move. So the other 3 were examples of chattels, and you do need to know about the rules about how to treat them, but the actual definition is tangible movable property. Spot on. Well done, guys. Something that depreciates, that's called a wasting asset. So you do have to pay capital gains tax on that. No one put that, but it was just another one to try and trip you up in there. Good. So if it's got a life of less than 50 years, we call it a wasting chattel. If it's got a life of more than 50 years, then we call it a non-wasting chattel. So you're absolutely right. It was a nasty question. They were all examples of chattels, but the actual definition is tangible movable property. Perfect. Well done, guys. We've got 1 question left. Let's have a look at our leaderboard before we go into our final question. Lucy being the fastest there, but it looks like Scott's holding on to his top position. Okay, last question. Read this one really carefully, guys. Which of the following assets would not be exempt for capital gains tax? So which of the following assets would you have to pay capital gains tax on? A vintage car, cash, foreign currency, a snake, or rented property? So if you saw some of these come through in your exam, which one of them would you have to calculate capital gains tax on? And the other 4 would be exempt. So in your exam, you could state they were exempt and you would get a mark for doing so. Perfect. Well done, guys. Absolutely. Rented property. You're absolutely spot on there. That would be what you would pay tax on. So remember, if I'm a landlord and I rent a property out to either an individual or another company, I'm going to have to pay capital gains tax on that. So you're absolutely right there for those 11 people. Vintage cars, you absolutely never pay capital gains tax on. They're always, always exempt. Look in your notes for where you've got a list of exempt assets and make sure you are aware of them. A bit like the income tax that we spoke about on week 1, you should have another list that does tell you exactly the same information, but will be exempt for capital gains tax. Any kind of car, it doesn't matter whether it's a vintage car, a hatchback car, a racing car, any car is always exempt for capital gains tax. Anything they put in front of it, ignore it. If it's a car, it's exempt. Cash, you don't pay capital gains tax on it because however you've received that cash, you've already paid some sort of tax, so there is no tax to pay on capital gains tax. Nothing to pay on foreign currency, so if you go on holiday, come back with some money. I mean, I don't know many people that do that. Come back with some money and change it back. If the exchange rate has moved in your favour, you do not need to call up HMRC and pay over some tax. It is exempt. And a snake would be seen as actually a wasting chattel. So any animal there would be seen as a wasting chattel, and you don't pay any capital gains tax on any wasting chattel. So again, have a look at the chattels chapter in your notes to make sure you're really comfortable with that. Good. If there's any questions, give me a shout on the chat box. Let's have a look at how that's affected our leaderboard then. Let's have a look who's going to finish at the top. Oh, right at the last minute, Lauren picked at the post and it would come up there. Absolutely spot on. Well done. So Eva's just asked the question, what if a snake lives more than 50 years? For the exam, it doesn't. On average, they don't. There are a couple of animals that would actually break the rules. So an elephant, for example, you would actually pay capital gains tax on, but you will not see any animal in your exam that they think lives longer than 50 years. So the ones that you see are snakes and racehorses. They're both seen as wasting chattels. You don't need to, they just assume that they wouldn't have a useful life of more than 50 years. Even if a racehorse lived for longer than 50 years, it won't be racing for more than 50 years. So both of any animal in your exam is going to be exempt from capital gains tax. There are some exemptions, but you don't need to worry about them for your exam. Perfect. Any other questions on that quiz that we've had a look at? If you just pop them in the chat box, what I'll do while you're doing that is I will just change over to my iPad screen so that we can start having a look through our questions. Okay, hopefully everybody can now see my screen, and I'm just going to start off by having a look at this task bank. So can everybody see that? Can everybody see the tasks, a list of tasks on the screen? Good, perfect. So no technical issues there then. So I just wanted to tick off for anybody that was new to joining us, the tasks that we've looked at and what we're going to look at tonight, and it will just show you that we're not able to cover all of them in our 4 sessions together. So I'm sure some of you may have seen on the First Intuition live webinars, these sessions will be carrying on till the end of the year, so these revision sessions. They won't be me. Next week will be my last one, just because I'm going on maternity leave the week after. So I don't have any information yet about who's taking it over and what the format will be. But hopefully by next Monday, I'll be able to let you know. Thank you very much. This next week will be my last one. So I will pass on all of the information that we have been through, but there will be somebody else, which is amazing news, carrying these on till the end of the year. So that's absolutely fantastic. Thank you for all the congratulations coming through. That's absolutely lovely of you all. Thank you. So we've covered in session 1, task 2 and task 3. So we've done those 2. Last week we covered task 6 and task 7. Tonight we are going to look at task 8 and task 9. And next week we are going to look at task 12 and 13. So you can see 4, 5, 10 and 11 and 1 we haven't actually had the chance to cover. So I just want to make sure, just in case the format is slightly different when these get carried on, that you have in your own time had a look at those ones. The reasons I haven't done those is because the ones that I've picked I think are the harder ones in the exam. So I've tried to pick the most difficult ones for us to go through on our 4 sessions together. So this evening we are doing tax planning and the basics of capital gains tax, which is task 8 which is worth 7 marks in your exam, and task 9, which is worth 10 marks in your exam. So that's our evening. And then next week, we've got my favourite tax, inheritance tax, which generally students do find the hardest tax because they aren't very familiar with it. So they haven't seen any of it at work, or they haven't worked with any of it. So that will be our last session that we do next week. Has anyone got any questions on any of that, or any concerns or anything that they'd like to say just before we do move on and have a look at these tasks? Super. So we're going to start off with task 8. So as always, we always have a look in our tax tables as to where the relevant information is. So when it's on our tax planning, it could be on anything, to be honest. Capital gains tax is 12 and 13 in your exam, which we will use for task 9. But when we are talking about task 8, because it's on tax planning, it could be absolutely anything in the syllabus. And we've seen a couple of examples in our Menti quiz as to the kind of thing that could come up. So sharing dividends equally. Another one that's very common is sharing savings equally, for example. All those things where you've got those special rules that you learn, but you don't have to think about them in the same way. That's why it makes this task really difficult, because it actually asks you them in a different way. Very often there is a lot of multiple choice questions. You can see here, part A and C is both multiple choice, but it's not always one's correct and one isn't. So it's not always a 50-50 chance. In these examples, there is actually one answer that's correct for each, but sometimes you could have a couple. So you do need to have a really good understanding of the syllabus to be able to get these questions right. So part A, let's have a little read and see how we got on as part of your homework. Oh my goodness, I'm so sorry, I haven't sent the files. Hang on 1 second, just in case anybody hasn't got them. There's task 8. And there's task 9. So just in case anybody did register this afternoon and hasn't got the files, they should have just come into the chat box. If you can't open them for whatever reason, just follow along with the recording and they will be sent out to you at the end of the session with a link to everything else that we've done as well. So you'll be able to catch up on those. Good. Let's have a read through of this information then. So we need to show whether the following statements are true. Level 4, they're not necessarily going to tell you how many boxes that you need to tick for correct. So it could be that both of them are true, it could be that both of them are false. Sometimes they may tell you, but at level 4, it's not a definite that they will actually tell you in the exam. So you do need to be really, really confident with your answer. So let's read the first one then. We've got Paul has held shares in an ISA account. The first £20,000 of dividends received per annum will be exempt from income tax. Do we think that is true or do we think that is false? Brilliant, perfect guys. False, 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 false. What is the 20, well done Eva, you've just read my mind as well. I was going to say, what is the £20,000 for? Eva's absolutely correct. Eva is the max, sorry, £20,000 is the maximum that you can invest in an ISA in the tax year. So you can put £20,000 into a cash and stocks and shares ISA. That's the maximum you're allowed to put in. You can't put in £21,000. It will be tax-free, but it's not exempt from income tax. Perfect, good. So the dividends will not be exempt from income tax, only £2,000 will, and the rest will obviously go through normal tax rules. So you're absolutely right, so that is not true. So I'm just going to put a little cross over this side, but you wouldn't tick that box. Good. Let's have a look at the second one then. So all taxpayers, regardless of their marginal rate of tax. Does anyone know what marginal rate of tax means? Any ideas? Very, very close, Rachel. Yeah, pretty much. Rachel said it's the rate they pay. So what it really means is, Lydia's got it spot on. It's the highest rate of tax they pay. So if you are a basic rate taxpayer, your marginal rate of tax for income tax will be 20%. If you are a higher rate taxpayer, the marginal rate of tax that you will pay will be 40% for your income tax. So it just means there, regardless of the highest rate of tax they pay, so what tax band they fall into, so basic, higher rate or additional rate tax, they are all entitled to £2,000 dividend allowance at 0%. What did we say? Do we think that's true or do we think that's false? Super, guys. Lots of truths flying into the chat box. Absolutely well done, everybody. You're absolutely correct. It doesn't matter how much other income you have. No matter what income you have, the first £2,000 or dividends will always be taxed at 0%. And that's actually on your tax tables. And you should hopefully be comfortable with that by the time you get to the exam. Good. Any questions on that first one? Are we comfortable with that? Super. If there are, obviously let me know and we'll go back through it. That's absolutely brilliant. Part B, I love this question. It's a really, really backwards question. So Eva just said, I thought any income from ISA was always exempt. You're right, but you've got dividends there received from an ISA. So if you've put money into a stocks and shares ISA, any interest you receive from that would be exempt, but the dividends wouldn't be. So you can still receive dividends from that amount. They will be taxed as normal dividends, but any interest will be exempt. Hopefully that makes sense. Perfect. Okay, so love this next question. Let's have a look. So throughout 1920, Lenny is provided with a company car with a scale charge percentage of 22%, which gives a taxable benefit of £3,960. He would like to change this car for one with lower emissions and is considering one with the same list price, but with a lower scale charge of 16%. Lenny's a basic rate taxpayer, which means they pay tax at what rate? Perfect, well done guys, 20%. So we need to calculate the income tax saving if he opts for a car with the lower scale charge. So this is I think this is quite a difficult question, and it's one that really, really tests your understanding. How did we get on with it? Did people like it, or was it quite a difficult question? Some of you might not even have the answers, so you're not even sure how you got on. If I just tell you then that the answer is 216, just in case you haven't been able to check your answer, hopefully that gives you an indication as to how you got on. And let's have a look at some workings down here so that I can send this out to you. So anybody that hasn't joined us before, all of this page will be saved on the Dropbox at the end. So anything I write at the bottom, you will have access to as part of your boxes. So this is a hard question. So the first thing we need to do is that we've got a taxable benefit of this company car of £3,960. Now, if you think back to when we did our benefits session, to identify that 3,960, what we've done is we've taken the list price of the car and we've multiplied it by 22%. And that has given us £3,960. So before we can calculate any sort of tax, we need to work backwards to identify the list price of the car. Does anyone know how to do that? Give it a go on the chat box. Nadine's got it. Perfect. Everyone's almost there. Everyone's almost there. Let's just have a little chat. So most of you are pretty much there. They're just missing the last bit. So if it's £3,960 was your taxable benefit, that represents 22% of the list price. So if I divide that by 22 and multiply it by 100, what that's going to do is it's going to say, right, 3,960 was 22%. To actually gross that back up to 100%, that means that the list price of my car is £18,000. Is everyone happy there? So 3,960 represented 22% of my list price. So I've grossed it back up to the 100. So I now know that this car was worth £18,000. If anyone's got any questions, just pop that in the chat box. I can now take that £18,000 and I can say, right, okay, how much will my benefit be if I have a car of 16%? So I know that I'm going to pay tax on 3,960 when it's 22%. Now what I want to do is work out how much tax I'll be able to pay when I've got 16%. So I'm just going to do this and then I will answer any questions because I can just see there that. Let's just have a look. So I've just actually seen Natasha's questions. And Natasha did 3,960 divided by 22 times 16, which is the old one and then the new one. And that gives you the new benefit. And absolutely that would work. That's another way of doing it. And that's absolutely fine if you did. But what I asked you for was the list price. So you're absolutely spot on there. I'm just doing it the long way. Because if the question asks you for the list price, I want to make sure that I've given you all of the tools to be able to answer all of these parts of the question. But you're absolutely right, it would work. So I've taken my £18,000 list price. I'm now going to multiply it by my 16%, which is my new scale charge, which will give me a benefit of £2,880. So when I had 22% as my scale charge, my benefit was 3,960. Now it's gone down to 16%, it's 2,880. And the question asks me, calculate the income tax savings. So the benefit is going to have reduced by 3,960 less 2,880. So my benefit is £1,080 lower than it was before, but that's not how much tax I'm going to save. You just told me that he was a basic rate taxpayer, and now because of that, he was going to pay tax at 20%. So my tax saving is going to be that 1,080 times 20%, which is my 216. So quite a fiddly question there, and it really, really tests your understanding of how you calculate your benefits on your cars. Quite a different way of answering it. So how do we feel about that? So if we didn't get that the first time, are we now happy with it and happy that we'd know how to do that if it came up again? Good. Perfect. Super. So you could have obviously taken that other step. You could have just multiplied the benefit and that would have been quicker in the exam. But I just tried to show you because they could have said what was the list price of the car. That's how you would do that calculation. But it's really good, obviously, because it is a tax planning question, because it says that actually how much would you save? Well, you'd save £216 in tax. Depending on the person, that might be worth taking that lower emission car. However, they might turn around and say, well, actually, that's not worth it for me. I'd rather pay more tax and have a much higher performance car that's got an extra 4% of CO2 emissions. So we don't know that. We don't know any information about that, but it could go on to say, was this worth it? And you would have to look at the information in the question and decide whether a saving of £216 would actually be worth it for Lenny. Super. Okay. I think it's quite a difficult one there, so well done if you got that. That's really good, guys. And actually, if you didn't get it, don't worry, as long as you're comfortable that if that was to come up again in your exam, that you would actually know how to deal with it. Good, let's have a look at part C then. So, Jim is married to Barbara. You're likely to get a married couple somewhere in your exam, because what they're going to do is they're going to give you some information about the income for this couple, and they're going to ask you to give some advice based on the information that you know as to how they should split it. So this is generally an okay question because it's obviously a tick box, but it does actually involve you having quite a lot of background knowledge from your syllabuses. So you need to make sure that you're really, really comfortable with being able to answer them. So let's have a look. So we've got Barbara. She earns a salary of £195,000. Is Barbara a basic rate, higher rate, or additional rate taxpayer? Good, perfect. Well done to those answering. Good. She is an additional rate taxpayer. So if you're not sure about that or how to calculate that, remember all of the rates for income tax, this is where I scribbled over it in our other sessions, are given to you in your tax tables. So remember, you take off your personal allowance, and then after that you've got 3 bands that give you the basic rate, the higher rate, or the additional rate tax. So make sure you're comfortable with those. But remember, these are given to you in your exam. So if you're a first tuition student, they are all in your folder, or they are on My Rogo or MyFI. If you're not, you can get these on the AAT website. So make sure you are comfortable with where all this information has come from, because it's given to you in the exam. Good. So you're absolutely right. She would be an additional rate taxpayer with 195,000, which means that we know what rates of tax that she pays. Good. Let's have a look at Jim then. So Jim earns a salary of £15,000. Jim also earns income from his savings account of £25,000. Is Jim a basic rate, a higher rate, or an additional rate taxpayer? Think about that personal allowance, and then think about where he would fall. Well done, Lucy. Well done, Nadine. Good. Super. You're absolutely right. Jim is a basic rate taxpayer because he's got a salary of 15,000. He's then got incomes of his savings. You would take off the personal allowance, which we just saw on our tax tables there. He's 12. Let me just delete some of this. This is from when we scribbled on it 2 weeks ago. You'd add those together, take off the personal allowance of 12,500, and then the rest of his income falls within that 37,500 bracket, so he would be a basic rate taxpayer. So when you're reading these questions, before you even read the scenarios, I would identify whether they are a basic rate, higher rate, or additional rate taxpayer. Then we can start reading the information, and then we're going to be able to identify what would be the right course of action. So we need to tick the box giving the most suitable advice to the couple for the savings income. So this £25,000, when we read the boxes in a moment, they're going to make a decision as to whether or not to leave it with Jim, or whether to split it between both of them, or whether to maybe give all of it to Barbara, for example. Now, just remind me, when we're talking about a savings allowance, we're going to have a look at this on the tax tables in a minute. If Barbara is an additional rate taxpayer, how much does she get for savings? Good, perfect, nothing. Remember, HMRC and Robin Hood, they take from the rich, they give to the poor. So if you are an additional rate taxpayer, you earn enough, you don't need any extra help, your savings allowance is going to be nothing. How much do you get if you're a basic rate taxpayer? Good, well done to everybody, super. Lots of people answering there. 1,000, you're absolutely right. And for higher rate, just for completeness? Good, well done guys, 500. Now you don't need to know this, again, it's in your tax tables. So if we have a look back at our tax tables, you've got your savings allowance for your basic rate and higher rate taxpayer, 1,500, and for additional rate, you don't receive anything. So there's nothing in there in that box. Good, so we're now armed with all of the information that we need to be able to go through our answers. Now, there is just one answer that's correct, but you still need to make sure you've gone through and checked all of them, because in the real exam, that might not always be the case. It may be that there's more than one. It does say tick the box, so it does indicate here that there is just one, but we need to make sure that we are really, really careful. So let's read these really carefully. So first option, leave all of the savings income in Jim's name, as he gets £1,000 of savings allowance, and the rest will be taxed at 20%. What do we think, true or false? Absolutely, guys. Spot on. Perfect. Absolutely. Well done. It's definitely true. And we've already looked at that. We know that he gets £1,000 of savings allowance. So the first £1,000 will be taxed at a rate of 0. We also know that he's a basic rate taxpayer, which means the rest of it is going to be taxed at 20%. Okay, absolutely, Eva, you're absolutely right, but we're just going to go through these bit by bit and just have a look at each of those questions and not look at too much in one go. Good. Now, we know that one's true, but let's make sure that we're really comfortable as to why we're not going to do the others. So, next one that we've got, split the income equally and use both Jim and Barbara's savings allowances. Well, Barbara doesn't get one. We've already identified that she doesn't get one. So that can't be true because Barbara's savings allowance is nothing. So that's definitely not true. So I'm definitely comfortable that that wouldn't be right. Finally then, let's have a look at the last one. Split the income between them in a proportion that would make use of both Jim and Barbara's savings allowance, with the remainder being taxed at 20%. Well, there's two things wrong with this, and Eva's absolutely spot on with what she's written in the chat box. One, Barbara doesn't have an allowance, so if we split it based on a proportion, she wouldn't have any. And secondly, the remainder wouldn't be taxed at 20% for both Barbara and for Jim, because Jim pays basic rate at 20, but Barbara is going to pay higher rate for savings income, which we have a look on our tax tables, is going to be at 45% if she takes any of that extra income. So we can be really, really comfortable that that one is also not correct. Is there any questions on that? Are we happy with it? It looks like people are quite comfortable with that. Good. Perfect. Hopefully everyone's quite happy. I think the tax planning question is one of the hardest in the paper because you can take an easier guess because it is quite multiple choice, but we've had to know quite a lot of information in that question to be able to answer that. Now, this one's on income tax, but it could be on any of the taxes in the paper. So it could be on national insurance, it could be on capital gains tax. So it does mean that you need to have a really good understanding of the other questions and the other parts of the syllabus to be able to obviously pick up on those marks. Let me just read Boris's question. If anyone else has got a question, pop it in the chat box. So Boris has just asked, so if they split income, the rate of tax remains the same based on the individual salary? Absolutely. Remember, every single person is taxed as an individual. If you are married, it makes no difference to tax. I think there's a very, very, very small benefit to being married that you do see in higher syllabuses, but you're all taxed as an individual. So if you've got £100,000 of savings coming into your partnership, into your civil partnership or your marriage, if you split it equally, each partner will be taxed on £50,000. So if they both work, it will make quite a big difference in terms of how you're going to calculate it. So the tax planning question, like we saw earlier, is worth 7 marks. So 7 marks for that question. Let me just read Rachel's. If she was higher rate, could the savings be split to use her savings allowance, not 50-50, but 80-20? Yeah, absolutely. It could be done that in that way. Absolutely, it could be. Practically, if this was in real life, if you're thinking about splitting some savings with your partner, you just have to make sure that in terms of like all the legal documents behind it, that you have split it legally in that way as well. So, but absolutely, you're absolutely right. She could have split it, and that's absolutely fine. And then they'll be able to both use part of the savings allowance, and then the rest probably should still go to Jim because he's a basic rate taxpayer. Good. Any other questions on this before we have a look at task 9? Super. Remember, this will all be saved onto the Dropbox. So if you do want to open up my notes and my scribbles, they'll all be saved on there. So you'll be able to open those up, and I'll do that before I send out the recording after this session. Good. Task 9 then, so we're going to look at now. This is worth 10 marks. Capital gains tax, my second favourite tax to inheritance tax. There is some workings here that we've got to go through, but we've also got some multiple choice questions as well. So just to remind you in terms of where this is in your tax tables, you have got sections 12 and 13, which we looked at a moment ago. Capital gains tax rate, so you are given the basic rate and the higher rate tax of 10 and 20%, and you are given the annual exempt amount that we had in our Mentee of £12,000. That's all you're given. That's all you're given for capital gains tax. So you do need to know all of the chattels rules. You need to know how you calculate your part disposals, which we're going to have a look at in a moment. So you do need to know quite a lot for capital gains. You're not given a huge amount in the exam. So please do be aware of that, of what you have been given in the exam. Good. Let's have a look then at part A of this question. So James made a number of disposals during the year. We need to identify which of these statements are true. So we need to really carefully read them in our exam. So let's have a little read through. There would be no gain arising on a disposal to James's civil partner. Do we think that's true, or do we think that's false? Good, lots of truths coming in. You're absolutely right. Does anyone know why that's true? Perfect. Well done, Natasha, Eve, and Nadine. Yes, absolutely. So it's going to be done at no gain, no loss. If you make a sale to your civil partner or husband and wife, you will never make a gain and you will never make a loss. The reason for that is, let's say, for example, my husband and I own a painting that's worth quite a lot of money. If I sold it to him this year, he could make a gain of, say, £12,000. So he wouldn't pay any tax. Next year, he could then sell it back to me and I could make a gain of £12,000. I wouldn't pay any tax. And we could keep doing that every single year. And then when we decided to sell it outside of our couple, the cost that I paid for it is going to be so inflated that my actual gain is going to be really, really tiny. And the chances are we have a joint bank account. We don't have separate money. So every time I transfer this asset between us, I may be transferring over some money, but I'm just going to transfer it in and out of the same account. So because of that, because it's a way that you can manipulate how much tax obviously is paid, all transfers between husband and wife and civil partner are done at no gain, no loss. Good. If there's any questions on that, pop it in the chat box. If not, I'm going to have a read of number 2. So let's have a look. Disposals to James's cousin must be made at market value irrespective of the proceeds. Now, when do you ignore proceeds and take the market value of a transfer? When it's a connected party, absolutely. You've all answered the next part of the question. Good. When it's a connected person. So when you have a connected person in a question, you have to ignore how much the proceeds actually were and take the proceeds as market value. So basically, it's not quite as strict as between husband and wife, because it's likely that I might like my sister, for example, but not so much that I'd actually do it so that she didn't make any gain. I still want to get some money myself. So it has to be a connected person. But a lot of you have picked up absolutely correctly that James's cousin is not connected. So that is actually going to be false. Can anyone tell me then who is a connected person? So for your exam, who would be connected? Brother or sister? Absolutely. So it's really anyone that comes up and down in your direct line. So you'd have your children and their spouses. So my children and their husband and wife. Parents and their husband and wife, and grandparents and their husbands and wife. and business associates, but you're unlikely to see that in personal tax. It's more likely to come up in business tax. So you're absolutely right, but you're probably not going to see it in this exam. So just to recap that again, it's your children and their spouses, your parents and their spouses, and your grandparents and their spouses, not your cousins, your nephews, your aunts, your uncles. They are not connected. They're not close enough. So therefore they would just be a normal proceeds less cost disposal. Good. Perfect. Well done, guys. Any questions on that? Pop it in the chat box. If not, I'm going to have a read of the next one. Alex is just like, what about divorced parents with a new partner? Well, they're still parents, aren't they? So they're still a parent. Unless it's, yeah, that would still be connected, I think. As soon as they're connected to you, they wouldn't unconnect. You're not going to get asked that in the exam. Absolutely not. That would obviously be a spouse. Yes, sorry, Eva, your sister as well. Your sister and brother and their spouses also would be connected. Good. Okay, let's have a look at James then. So James made a loss when... James made a loss when selling a painting to his daughter. He can only use this loss against a disposal against his daughter. Do we think that's true or false? Lucy, straight in there. Good. Lots of correct answers there. That is true. Oh, God, let me change my colour over. That is absolutely true. So, if you have made a loss or a gain to any connected person, you then have to offset any loss against the same person in the future. And I'll give you an example why. So let's say I sell a painting to my sister and I sell it at a loss of £100,000. I'll be really, really generous. I'll give her a really good price. When you make a loss, generally, when you do your capital gains tax, you can offset a loss against any other gains in the future. So if I made a loss of £100,000 against my sister, if HMRC didn't put any restrictions on, I could offset that loss against any gains when I sold to a third party and therefore save myself some tax. So when you make a loss to someone who is connected to you, you can only offset that loss against gains to the same person. So to the same person only. So it's just a way for you to not be able to manipulate HMRC and save yourself some tax elsewhere. So that would actually be true. Everyone happy with that? Good. Let's have a look at our last one then. So we've got a last example with James. So James sold an asset to his civil partner for £30,000. It originally cost £2,000 and his partner is going to go and sell it, and we're going to say that the allowable cost is £30,000. Now, thinking back to what I said for the first example, do we think that is true or do we think that is false? Absolutely. Good stuff. Loads of falses coming in there. So it's absolutely false, because remember, if it's a civil partner, when we transfer between husband and wife or civil partner, it's always done at no gain, no loss. So when you come to sell it, instead of selling it at how much we're saying that you bought it for, what you would do is the original cost that would go against it would be this £2,000. So I can transfer it to my husband and he can transfer it back to me as many times as we want. And there might be a benefit for us to do that, because remember, as we're both seen as individuals, we both get £12,000 annual exempt amount. So it might make sense for me to transfer it to him, but I'm going to do so at no gain, no loss. And when he sells it outside of our marriage, he will have to take the original cost that we paid for it, not how much we transferred it between each other. Hopefully that makes sense. Good. If there are any questions, pop them in the chat box. We've got B and C to have a look at. So Alex just wrote, what threw me is the fact that he sold it for £30,000. So he sells the asset to his civil partner though. So it's like me selling the asset to my husband. Yeah, but remember, he's going to sell it for £30,000. They would then take off the annual exempt amount, and essentially the civil partner would have to pay some tax on it, but it would be lower amounts. But you're absolutely right. They still might sell it across, and it's just basically because they're married, they'll probably just be transferring that money within the same bank account. When you see it as civil partner, just say, right, no gain, no loss. And when you actually sell it outside of the partnership, you need to take that lower figure. Hopefully that now makes sense. Good. Okay, let me know if there is any more questions on that, Alex. Good. So for part B, let's have a read of our questions. So we have got Jackson. Jackson sold a third of his field for £50,000. The remaining area of the field was deemed to be worth £40,000. And it originally cost £18,000. When you read that sentence, what does it make you think of? Nothing? Good, well done, Jordan. Absolutely, Lydia, good stuff. A part disposal. So this here, the remaining area of the field, should be an exam trigger to you to think that you have a part disposal that you need to think about. So as soon as you hear that, you think, right, I've got a part disposal, so I need to not take off the whole cost. I need to use the formula A over A plus B. And we're going to talk about that in a minute as to how we do that calculation. So this should be an exam trigger for you to make you think about it. Now, whenever I think about capital gains tax, I always try to use the pro forma, proceeds less cost. Now, there is likely in there to be something unusual. So you might have a chattel where you need to change the cost. You may have some selling costs that you need to take off. You might have some buying costs that you need to take off. In this scenario, we've got a part disposal that we need to think about. But I will always try and fit it into proceeds less cost and fill in my calculation. So I've sold a third of my field for £50,000. So that's going to be my proceeds. So I can pop £50,000 into that proceed. For my cost, I can't take off the full £18,000 that I spent because that £18,000 actually wasn't for what I've sold. I've only sold a third of that. Now, a lot of people in the exam might say, well, okay, I'll take a third of it. But in real life, what if I've got a piece of land and the piece of land that I've sold has got planning permission on it? That means that that piece of land that I've sold is going to be worth a hell of a lot more than the rest of the land where I haven't got planning permission on. And that's why we use our A over A plus B. Now, can anyone tell me what A stands for? Doesn't have to be the actual definition. Perfect, well done, Lucy, sorry. A is the value of the land sold. And what about B? Perfect, the market value of the remainder. Now, there could be different ways that could be written in your notes, but that's what you're thinking of, and that's absolutely spot on there, guys. So when we do A over A plus B, what we're essentially doing is we're finding out the proportion of the bit that we've sold over the total value of the asset. And we're going to multiply that by the cost. So in this question, the cost was £18,000. I can't deduct the full £18,000 because it doesn't relate to all that I've sold. So I need to multiply that by A over A plus B. A, we just said, was the value of the land that was sold, so £50,000. So that goes in my top part of my calculation, but also on the bottom part of my calculation. And B, we just said, was the market value of the remainder, which we're told in the question was 40,000. You'll never have to work that out. They'll have to give it to you. You're not an estate agent. You're not going to be expected to know that. So you add on the £40,000 and then you solve that equation. And instead of saying, right, I spent £18,000, which I did, you're going to say, right, £10,000 is the proportion that relates to the value of the part that I have sold. Is everyone happy there? Now, I know we've been through that quite quick because this is revision. Obviously, on tuition, we spend quite a lot of time going through that calculation. So let me know if there is any questions on that in the chat box. While you're just typing, if you are typing, I'm just going to do the final bit then. So then we do our proceeds less our cost, which means that our gain is £40,000. So B would be our answer. Looks like everyone's comfortable on that. If you do want to ask a question in a moment when we've done part C, I'd be happy to go back through that and spend a little bit of time on it with you. So if you do have a question, hold on to it a minute while we do part C, and then we'll go back through it if you do want to. But well done there, guys, if you have got that. Remember, A over A plus B is not given in your tax tables. Neither is what A is, and neither is B. So you will need to know that for your exam. Good. Part C then, let's have a look. Again, I want you to think of proceeds less cost. And when we read the question, I want you to tell me whether or not I would be able to deduct that as part of our cost. Now, I'm not going to give you any heads up to start off with. I'm going to see how we get on, and then we'll talk about the rules and what we need to calculate. So let's have a read. So we've got Sue. Sue sold a holiday home that she'd never lived in for £300,000. What's £300,000? Proceeds. Super. Well done, guys. Remember, always think of proceeds less cost when you're talking about capital gains tax. £300,000 is my proceeds. Perfect. She originally bought it for £120,000. What's £120,000? Super, well done, guys. Perfect. Cost. So take off my cost of £120,000. And then we've got some other bits that we need to work out whether we'd be able to deduct these as part of the cost or not. So let's have a read. She spent £15,000 on a conservatory. Can I deduct that? Yes, there's a little bit of unsure there. Yes, I can. I think overriding it is a yes. I can deduct it because it is an enhancement. £15,000. So any enhancements you can deduct. Now, this is quite difficult for some people because it's different rules in accounting. So when you are capitalising an asset, it's slightly different. You need to ignore that when you're talking about tax. Taxman and the accountant doesn't always agree. When you are doing capital gains tax, anything that would increase this £300,000 can be deducted. So the fact that there is a conservatory on that holiday home means that she would be able to have higher proceeds and someone would pay more money for that property, so she can deduct it. So because it's enhancement, yes, it can be deducted. Is everyone happy there? Even if you didn't get it right the first time, are we happy as to why? Good, super. We've got two more things to look at. Next one then. She spent £3,000 on repainting the holiday home. Can she deduct that? Perfect. Well done, guys. No, you're absolutely right. She can't. That is seen as a maintenance on that property. Every year before people come in and stay in her holiday home, she's going to paint it so it looks really nice. It doesn't improve or increase the capital or that £3,000, so she wouldn't be able to deduct it. It's basically just another lick of paint to keep it at the same standard as she had before. What about then the final one that we've got? She also spent £2,000 on replacing the carpet. Can we deduct that? Well done, guys. Lots of people coming in with no's. You're absolutely right. Exactly the same answers there. She's had lots of people come in our holiday home. They've worn down the carpet. She's had to replace them to keep them at the same level. It's not an enhancement. Someone isn't going to pay more for the property because she's replaced the carpet, so she can't deduct it. Absolutely spot on. So anything that would increase the capital can be deducted. It will be seen as enhancement. Anything else cannot be deducted. Not for capital gains tax anyway. It can be elsewhere, but for capital gains tax, it can't be deducted. Good. So the last thing that I'm going to need to do is take my proceeds, take off my cost, take off my enhancement, which gives me £165,000, which would be the chargeable gain. Super. Any questions on that question first, and then we'll open it up to any other questions about anything else? Kari's just asked, do we not take the allowance? I'm assuming you mean the £12,000. Someone answer for me why we don't take off that £12,000. What is the key word in that question that means that we don't take it off? It's a great question. I'm really glad you asked it. I know what you mean, Danielle, but what's the key word that means we don't? Perfect. Well done, Nicholas. Absolutely. The key word is that the question asks you for the chargeable gain. So the chargeable gain means before the annual exempt amount. So if you think back to when we did our income tax, if you had total income, that was before the personal allowance. When you had taxable income, it was after the personal allowance. It's exactly the same for capital gains tax. A chargeable gain is the sum of all of your gains added up. When you take off the annual exempt amount of £12,000, that then becomes the taxable gain. So here they have asked you for the chargeable gain, and therefore you don't take it off. If they ask you for the taxable gain, you need to take off that £12,000. I'm really glad you answered that question, because a lot of people would have taken it off and you'd get no marks in that question. And even if it was multiple choice, they would definitely have both of those answers as your options. So I'm really glad that you did actually ask that. So when it's chargeable gains, you've got that. Let's just make sure we're over here. If I've got total income, you take off the personal allowance, and then you'd have taxable income. Make sure you're really, really comfortable with both of those. Louise just wrote 153 taxable gain. Absolutely, the question doesn't ask you for it, but if it did, you would then take off the annual exempt amount. Really good question. I'm really glad that you did ask that. Does that make sense? Good, perfect. Any other questions on that question before we open it up to open questions? Good, okay, well, thank you guys. That is the end of our session for this evening in terms of our tax. So we'll open it up for questions in a moment. Next week is our last one, so it's on inheritance tax. So at the end of this session, I will send out the pre-work for next week, and it'll be our last session together. So if anyone does want to drop off, feel free to, and I'll see you next week. Or if you're watching on the recording, fantastic. If anyone's got any questions, I'll obviously go through it. So Eva's just asked, can I tell us more about the new mock product? So did you receive the link that I sent out to you last week? Yeah, so if you look on there, that's got all of the information as to what it includes. So it's £15 and you get access to a couple of mock products where you can have them marked for you. And you do get feedback, and there is a recording of mock 2. So if you click on the link, there is a real detailed list of everything that's included. Eva, I'm assuming you don't study with first intuition. So if you do study with first intuition, everything will be included already as part of your package. But if you are an external student, it's really, really fantastic product, and I think it's actually really good. It's really good value as well. £15, you get access to marks, and you get yeah, Eva, so there is someone won't correct them, no, but they will give you some feedback and they will mark it for you. So yes, so you will get some feedback marked. I'm not exactly sure in what sort of format it comes in, but all of that information is given to you on there. If you've got any more information, there's also an email address on there for the people that are running the products. They'll be able to give you some more questions. Hopefully that answers your question. Thank you again, guys, for the congratulations. Does that answer your question, Eva? Are you happy with that? Perfect. Okay, let me just go back and just check if there's any other questions that I've missed. Thank you to all the lovely messages to see you next week. That's lovely. Alex has just asked, is Part C under capital gains in the FI manual? Yeah, absolutely. So capital gains tax, all of this is in the FI notes. Yeah, absolutely. So this is quite core in terms of what would be included. So that's all in there. Yeah, absolutely. Thank you for the congratulations, guys. Rachel, what's ICB? I don't know what ICB is. Just pop to ICB at the bottom. Kate's just asked, you mentioned these sessions will go on to the end of the year. Is that academic year or calendar year? Everything's calendar year. So FI aren't expected to be back into the classroom until January. So we're going to carry on doing these as revision sessions. Obviously, even though you guys can still start sitting your exams, you can go into centre now and be able to sit your exam. We're not actually going to start tuition up until then. So to the end of the calendar year, there should be these, but I just don't have any more details about them yet. So I'll try and get that for next Monday for you. Hopefully they'll be on the same night at the same time. It will just be a different person running them. Institute of Certified Bookkeepers. Let me just reread your question. Lost your question now. Can you retype your question? Sorry, I've lost it. There's so many messages coming through. Oh, I'm currently under ICB. Do you cover that on the mock package? Have a look. Have a look on the link that I sent out. I'll resend the link out. How to do the mock products. I'm not sure what they cover because that's just two levels, isn't it? I think they are covered, but just have a look, log on. Anything that's on £15, it means it's covered onto that information. Beth just asked, how do you sign on to next week's revision session? Well, if you've signed on for tonight, you're already signed on, so you don't get taken off. So I will do it in a minute and I'll send out all of the information over. Thank you, Eva, that's really nice. Shame someone else will be doing them. It'll be someone equally the same. We're all very similar. And actually, if anything, it'll be really good because it will be different questions, which will be really, really helpful to you, obviously, to be able to do those. So someone different will just to cover different parts of the syllabus. Just think about it as a positive. Lovely, that's lovely messages. Thank you very much, guys. I'm just going to turn off the recording and turn off the video. But I will just hang around for the next few minutes. If anyone has got any other questions that they didn't want on the recording or anything, feel free to pop them in and I will answer them. See you next week, guys, and hopefully it's all been useful. And next week's inheritance tax, which is the best, my favourite tax, which I know is very weird, but lovely. Thank you very much.